I'm a baby boomer. I'm about to retire. It's scary. I'm about to turn off that paycheck that's coming in each week, and I'm about to kind of make that leap into retirement. In your opinion, what are some of the biggest roadblocks or risk out there for people who are just now entering into retirement?
Well, yeah, retirement's a completely different way of life from what people are used to. You're no longer just adding new savings, but you're now having to really think about taking distributions and spending down the asset base. And that's really a different experience for people. That pre-retirement, you have more flexibility to back on track if your money is mostly in the stock market, or at least a big chunk of it, but you have that flexibility to respond to a stock market downturn. Post-retirement, you're really becoming more committed to your financial plan. You're going to have one opportunity for a successful retirement, and it may be harder to go back to work. It may be harder to make other kinds of adjustments if the stock market goes down. And so your views and attitudes towards stock market risk can change in retirement because your lifestyle can become more vulnerable. And I think people who are really relying on the idea that stocks will perform well, which they have for a number of years now, but there's no guarantee that will continue indefinitely. And if your retirement's dependent on getting that consistent stock market growth, it can really make for an uncomfortable retirement in terms of the worry about the stock market. And if something does happen, what impact would that have on the financial plan in terms of allowing it to work? So that's really, retirees need to think about stock market risk in a different way because their mindset is transitioning from accumulating and adding to their asset base to having to take distributions from their asset base.
A paper or some research with Michael Finke on spending flexibility and safe withdrawal rates. Can you talk a little bit about what that is and how that influenced some of the stuff in the book?
Mm-hmm. Yeah, so that's getting at the idea that for most people, they're not just reliant on their investments. Somebody who with Social Security and who may also have another traditional company pension, maybe has some other income coming from an annuity, might have most of their lifestyle expenses covered by resources from outside their investment portfolio. And that can create a lot of flexibility that your lifestyle is no longer as vulnerable to if you spend down your investment portfolio and then you can't take as big of distributions from your investments in the future. Well, your lifestyle is pretty much covered. And that can create a lot of flexibility for people in terms of being able to spend more from their investments today, enjoying their early retirement more because they do have that flexibility to reduce the expenses from or the distributions from their investments later in retirement, since they really do have so much of their lifestyle covered with these other resources from outside the investment portfolio. So spending flexibility is very important. We hear a lot about this retirement crisis, which is the idea that people have not saved enough for retirement, and the average American getting to retirement with a very small amount of financial assets and will have to mostly rely on Social Security and home equity. But for people who have saved some assets, where something like the 4% rule is actually meaningful to think about because they have a financial portfolio where 4% of that portfolio is a meaningful number to be thinking about, that people with assets really do seem to underspend. They, even with very conservative assumptions, they spend less than really maybe at a very conservative type of assumption reasonable. And it may be a host of factors, that just this idea, the 4% rule assumes you're willing to spend down your principal. And for a lot of people, they're willing to spend income generated from their portfolios, but they're not very comfortable spending down principal. And then as well, they may just worry about outliving their money. And so they really that's another reason why they may not be comfortable spending down principal. And then there's all the contingencies facing retirees with health care, spending shocks, long-term care events, and all these spending surprises that can happen that in the end also just leave people feeling like they may have a pretty big base of financial assets, but they're just not comfortable spending it because they're worried they may need it for these types of spending shocks that can happen later in retirement.
It almost, as a planner myself, it almost sounds like a Goldilocks zone. Either there's not enough, or you end up with too much at the end. I'm